Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of those big corporate filings by looking at the numbers behind the scenes. And let me tell you, ICF International's latest report definitely has some interesting trends to unpack, especially when you look at how their business is shifting. We're going to dive into their financial results for the second quarter and see what the numbers are really telling us about where they're headed. Before we jump in, if you're someone who likes understanding what's actually going on with companies beyond the headlines, make sure you're subscribed. We also have a growing community over on Discord where we break down these filings even further, so definite trash to clan pack, especially when you look at how their business is shifting. We're going to dive into their financial results for the second quarter and see what the numbers are really telling us about where they're headed. Before we jump in, if you're someone who likes understanding what's actually going on with companies beyond the headlines, make sure you're subscribed. We also have a growing community over on Discord where we break down these filings even further, so definitely check the link in the description below. So first off, a quick look at the big picture. ICF International is reporting on their performance up to June 30th of this year. They've got about 18.4 million shares of common stock out there, and they operate in a few key markets like energy, environment, health, and security. Now let's get straight to the money matters and see how they're doing. Looking at their balance sheet from June 30th of this year compared to the end of last year, we see some shifts. Their cash and cash equivalents went up from about $5 billion to nearly $7 billion. That's always a good sign. More cash on hand usually means more flexibility. Now, their restricted cash also saw a pretty big jump from around 13.8 billion to almost 20 billion. This restricted cash is often tied up in things like energy incentive programs or specific client agreements. So while it's not readily available, it's usually a sign of ongoing business activity. One of the most significant numbers here is their goodwill, which climbed from 1.248 billion to 1.253 billion. Now, goodwill is basically the premium a company pays over the fair value of net assets when it buys another business. This increase signals they've likely made another acquisition or that the value of a previous one has increased, which is interesting given the recent acquisition we'll talk about later. On the other side of the balance sheet, their total current liabilities, which are bills due within a year, decreased from about 449 million to around 393 million. That's a positive move, generally meaning they're managing their short-term obligations more effectively. However, their long-term debt went up considerably from about 411 million to over 462 million. This increase aligns with the higher debt levels mentioned in their financing notes and is something to keep an eye on, especially as interest rates can impact the cost of servicing this debt. Finally, their total stockholders' equity grew from about 982 million to just shy of $1 billion. This increase reflects their retained earnings growing, which means they're making more money than they're paying out in expenses and dividends. That's a healthy sign for long-term value. Now let's check out how the company is actually making and spending its money by looking at their income statement. For the second quarter this year, revenue dropped to about $476 million from $512 million in the same period last year. This is a nearly 7% decrease. So why is revenue down? Well, the report points to a big drop in business with the US federal government, mainly because of contract terminations and changes in government priorities. Interestingly, their direct costs also went down by about $30 million, mirroring that revenue drop. This makes sense. When you have less work, you spend less on the direct costs of that work. Their indirect and selling expenses, on the other hand, saw a smaller decrease of around $4 million. This means that while they're bringing in less money, their overhead costs haven't shrunk at the same pace. As a result, their operating income decreased by almost $2.4 million to about $40 million. It's a drop, but not a catastrophic one, and they're still profitable on their core operations. Now, one of the most significant changes is in their provision for income taxes. It fell pretty sharply from about 9.1 million last year to 6.3 million this year. This directly boosted their net income. A big reason for this was a research and experimentation tax credit, and also less foreign withholding tax, which happened last year. So even with lower revenue, net income actually dropped by a smaller percentage, almost 8%, going from 25.6 million to 23.7 million. This tax benefit helped cushion the blow from lower sales. Looking at the first 6 months of the year paints a similar picture with an even larger revenue decrease of over $42 million. Their net income for the first half of the year also decreased by about $244 million to $50.5 million. This decline is largely attributed to those government contract terminations, but importantly, an income tax benefit related to foreign currency and tax regulations has helped improve their overall effective tax rate. It's a complex tax adjustment, but essentially it means they paid less tax this year relative to their income, which makes their net income look better than it might otherwise. Now, earlier we saw that goodwill increase, and that's tied to their acquisition of Applied Energy Group, or AEG, back in December of last year. They paid about $60 million for this company, which provides energy technology and advisory services. This move is clearly aimed at bolstering their offerings in the energy sector. Interestingly, they had to adjust their estimates for this acquisition. They lowered the value of customer-related intangibles from an initial $21 million to $20 million and shortened their expected useful life. This kind of accounting adjustment happens when companies get more clarity on the actual value and lifespan of acquired assets. This acquisition also means more amortization expense, which is the cost of those intangible assets spread out over time. Their amortization costs from acquisitions went up by about 11% for the quarter and 13% for the half year. This reduces their reported profit, but it's a non-cash expense that's already factored into the purchase price. Let's talk about EBITDA earnings before interest, taxes, depreciation, and amortization. It's a common way to measure operating performance. For the quarter, EBITDA went down to about $53 million from $55.6 million. Adjusted EBITDA, which removes certain one-time costs, also went down. This reflects the tough quarter they had with lower revenue. Their non-GAAP diluted earnings per share also declined slightly. For the quarter, it went from $1.69 to $1.66. While it's a small drop, it shows the impact of those acquisition-related expenses and other adjustments on their profitability. Looking at their financial health, they seem to have decent liquidity. They have nearly $500 million available on their credit facility plus their cash reserves. They've also hedged a good portion of their debt to manage interest rate risk, which is smart financial management. However, their cash flow from operations took a pretty big hit this quarter, dropping from $50.6 million last year to just $18.9 million this year. That's a 63% decrease. This big change is mainly due to how they manage their contract receivables and liabilities. It means that even though they earned money on contracts, they didn't collect as much cash in the short term. This is a crucial number for any business. A sharp drop like this can sometimes signal that while sales might be okay, the actual cash coming in is lagging. It's important to watch this trend to see if it's a temporary blip or something more persistent. Overall, ICF International is navigating a challenging period, especially with those shifts in US federal government spending. The acquisition of AEG shows a strategic move to strengthen their position in the energy market, which is a good diversification strategy. However, the drop in operating cash flow is definitely something to keep a close eye on. It suggests that while they are working on important projects, the cash collection cycle might be lengthening, or there are other factors impacting immediate cash generation. They're managing their debt, and their tax situation seems to be improving due to some specific regulatory changes, which helps bolster their net income figures. But the core business is facing headwinds from government contract changes. So looking at the whole picture, ICF is still a profitable company with a clear strategy to diversify and grow. They're managing their finances prudently with debt and hedging, but the recent decline in operating cash flow and revenue from their largest sector, the US federal government, presents a significant challenge they need to overcome, either by securing more commercial contracts or by navigating the federal landscape more effectively. Alright, that's our deep dive into ICF International's latest quarterly report. What do you think about these numbers and the company's direction? Was that cash flow drop a worry for you? Let us know in the comments below. If you found this breakdown helpful, please hit that like button and subscribe for more corporate analyses. And don't forget to join our Discord community for more in-depth discussions. Thanks for watching Corporate Decoder, and we'll see you in the next one.